What's up, guys? I welcome you in this wonderful video. So today we're gonna be speaking about the moving average. So before I can get started, let me just put it on my chart. So this is the moving average here on my chart, indicated with a white line. So what you need to know about this indicator is that this is a trend indicator, because we have different categories of indicators. We have oscillators, we have volume indicators, we have a lot of categories, but this is under the category of trend indicators, meaning it goes with the trend, or it is there to assist in terms of trend trading. This indicator is also a lagging indicator, meaning whatever it plots in the chart is from previous data, meaning it follows the price. So what you can see here is that, as you can see price in that area, that area of the price is not similar to the area of this indicator, because this area of the indicator, or this point here, was plotted from previous information or from previous data. So what's the purpose of this indicator? The purpose of this indicator, it is to assist you in terms of identifying a trend. It is also to assist you in terms of identifying change in momentum. Let me just write CM. It is there to assist you in change in momentum and also in identifying clearly the trend. So what's the difference between the moving average and the price? Because as you can know, that the moving average is plotted from the price that is given by the candle. So what's the difference? The difference is that the moving average is here to give us a smooth version of the price, a smooth version of the price, and it is there to give us not just the specific current price, but the average price, because it is helpful sometimes to know what price is doing averagely, not currently, but how has it been behaving average, by combining maybe a list of prices to get the average price. So that's the purpose of the moving average. And one important thing you need to know, there is an input, which is the period. So if I can go up there and click my settings, you can see that we have an input here, which is the length. In this case, in some platforms it can be indicated as period. This is the most important part of the indicator, because it tells you how much information are you gonna look in your chart. Because if it's indicated with 60, it means that it's gonna go 60 days back before it plot, meaning this area here is plotted from the previous 60 candles, because this is the daily time frame. So each candle is equivalent to a day. However, you can change all that by changing here and say, I want this moving average to plot according to my 1 hour or according to my 4 hour. But in this case, I've chosen chart, meaning it's gonna plot according to the chart that I'm in. In this case, I'm on the daily. So this 60 is for the previous 60 days, meaning, let me just close, meaning at the beginning of this chart, we didn't have a moving average. Remember, the moving average, it follows the price, meaning at the beginning of the price, let's say at the beginning of crude oil, when the chart was plotted, we didn't have the moving average. The moving average had to wait for 60 days, meaning once 60 days is complete, that was the beginning of the first point which was plotted, and then the next 60 days was also gonna plot another point. Then when the points are connected, that's where we get the moving average, which is a smooth representation of the average price. I hope that is making sense. So we don't have just a basic moving average or one simple moving average. You know that we have different types of moving averages. Let me just clear my screen. We have a simple moving average, and an exponential moving average. So what's the difference between the two moving averages? Is that the SM, the simple moving average, is basically the one which I was explaining. It's just a simple moving average. However, the EMA, the exponential moving average, the difference is that it is weighted on the current price, meaning it plots in relation to what price is doing now. If I can just open it here, let me just make sure that the period are the same. Let me change it to 60. So it give more weight to recent price. That's why you can see here both the yellow and the white are at the same period, meaning they look at the same period. However, the yellow one, it changes more earlier, or it respond earlier than the white one. It respond more earlier than the white one. Let me just show you a simple example. So we can see here that price was going down and then started going up. However, the yellow moving average, which is the EMA, responded earlier. It started going up from here. However, it took the simple moving average some time to change and go up, meaning the EMA looks even at the current price and react more quicker to current price than the simple moving average. So that's why a lot of traders will always prefer the EMA over the SMA. I hope that's the case. So you shouldn't ask yourself, why are a lot of traders preferring the EMA compared to the SMA? It is because the EMA respond quicker to current price compared to the simple moving average. So I hope that that is making sense. So when it comes to trading, or when it comes to now executing your trades, let me just clear everything here. When it comes to now executing your trades, there are different approaches that you can use as a trader to make decisions. There are different approaches. The first one, they use this indicator. Let me just clear one. They use this indicator in relation with the price, meaning if they see price being above the indicator here, in this case price is flowing above, it actually means that price is moving in an uptrend, meaning they will only make bullish decisions as long as price is above the moving average. And when price crosses the moving average and goes below, it means that now the market is bearish, meaning decisions that traders should be making are decisions to go short. I hope that is making sense. And another method that they can use, I know that you might be familiar with this method, is by combining the moving averages with a bigger period and one moving average with a smaller period. So let me just change this one and make it 30. Make this one 30 and go there. So now we have two moving averages. See, let's make this one 60 and increase our weight like that so that we can enjoy seeing it visible. So we now have two moving averages. We have the pink one, which is a 60 period, meaning it is bigger. The period is bigger than the white one, which is a 30 period. So what traders do is that they observe where these two moving average cross. Where these two moving average cross. Why? Because the smaller one will respond quicker to the price, meaning the white one in this case will react quicker to the price, then the pink one will react late. So this, when the moving average crosses, it's a signal that, okay, now momentum is changing to the opposite side because it was going down and now it is changing going up. But because this is a lagging indicator, you can see that it gives you a signal a little bit late, not when the actual change took place. So it is always helpful to combine price action with the indicators, making sure that they help you to confirm what price action have already told you in terms of these highs and also the breakout here which happened under a test. So if you combine all these things, it will make a little bit of sense. And another method that they use, let me just go to the S&P 500. Another method that traders use to make decisions, let me just close that one. Another method that traders use, it is to use this moving average as a trend line. Instead of drawing a trend line, you observe when price bounces in the moving average, it treats that moving average as now its trend line, and then you can make decisions based on that. So when the price treats the moving average as a trend line, then you should take advantage of that and say, okay, when price approaches the trend, the moving average and bounces, then I'm gonna make decision just as it was behaving here. So I hope that is making sense. So that's it for this video. Thank you for watching.